You might think billionaires live in a different world because they have private jets, island getaways, and staff to handle everything from cooking to booking those five-star vacations. But in reality, there's an even bigger divide between them and us. And it's not just about what they can buy. It's about what they don't have to pay. While the average person stresses about tax season, billionaires are playing a game with rules most people don't even know exist, a game that allows them to legally owe $0 in federal income tax. And in 2025, that game just got an upgrade. This isn't about some old offshore bank account trick your uncle told you about. This is a brand new twist in the tax code that is quietly allowing the ultra-wealthy to avoid taxes entirely, while technically following every single law. Today, we're diving into how it works, why it's legal, and why it's probably not going away anytime soon. And yes, it's going to make you wonder if the system was designed to let this happen. How we got here. The evolution of legal tax avoidance. Let's rewind. Tax avoidance, not evasion, has been around as long as taxes themselves. Evasion means you're breaking the law, hiding money, or lying on your tax returns. Avoidance? That's the art of using the law to your advantage. And billionaires have entire teams of accountants and lawyers to make that happen. In the 1980s and 90s, the big moves were offshore bank accounts in Switzerland, shell corporations in the Cayman Islands, and elaborate family trusts. By the early 2000s, billionaires shifted to stock-based wealth strategies, avoiding income tax by taking loans against their assets instead of selling them. This was nicknamed by borrow die, by assets borrow money against them to live and die before paying capital gains tax. It worked incredibly well, until 2025 brought a new layer to the game. Digital asset trust loopholes. Here's the latest move, digital asset trusts. In short, billionaires are now placing AI-generated intellectual property, NFTs, and digital patents in especially designed trusts based in tax-friendly jurisdictions. These trusts are recognized under the latest tax code updates as non-physical, depreciable intellectual property. Billionaires can write off the depreciation of a digital asset that doesn't actually lose value, at least not in the real world. Example, a billionaire creates an AI-generated art collection, registers it as a valuable intellectual property portfolio, and assigns it an inflated valuation. Then, each year, they depreciate that value for tax purposes, even while the real-world value of those assets might be skyrocketing. The result? Paper loss is big enough to erase their entire taxable income. Offshore digital havens. You've heard of offshore bank accounts. In 2025, we now have offshore digital havens. Tiny nations and island territories are competing to become the Delaware of the metaverse. Places like Nevis, Vanuatu, and certain UAE free zones are offering zero tax on digital asset revenue. Billionaires are transferring ownership of their intellectual property into these havens. Once the asset lives there, all royalties, licensing deals, and usage fees are collected without ever touching the U.S. tax system. If they do need to bring money back, they can do so in the form of loans or management fees, which are either untaxed or taxed at minuscule rates. The $0 tax blueprint. Let's lay out how a billionaire could pull this off step by step. Create a high-value digital asset, AI-generated film scripts, metaverse land, exclusive virtual fashion lines. Place it into a specialized offshore trust in a zero-tax jurisdiction. License the asset back to a company they own in the U.S. Pay themselves in loans against the asset's future value, avoiding taxable income. Write off losses through depreciation schedules, erasing any paper profits. By the end of the year, their personal tax bill reads $0 legally. Why this is 100% legal? It all comes down to definitions in the tax code. If something is classified as a depreciable asset and you follow the proper paperwork, you're entitled to those deductions, even if it's a purely digital creation. And the IRS, already underfunded and overwhelmed, simply doesn't have the capacity to challenge every billionaire's valuation of their AI-generated art or metaverse holdings. Historical parallels. This isn't the first time something like this has happened. In the 1920s, railroad barons used phantom depreciation on train cars they never retired. In the 1980s, Real estate moguls claimed losses on properties while actually turning a profit. The same playbook is simply being adapted for the digital age, and with fewer regulations than ever before. Public reaction and political gridlock. You might think politicians would rush to close this loophole. But here's the problem. Many lawmakers benefit from the same strategies through their donors, lobbying networks, or personal holdings. Even when reform is proposed, it's often written in a way that quietly preserves the loophole for those with the right lawyers. Could you do this? Here's the kicker. Technically, yes. But in reality, the cost of setting up the legal structure, hiring tax attorneys, and building the digital asset portfolio can run into millions of dollars. It's a game designed for the ultra-wealthy because the barrier to entry is simply too high for everyday people. The future of billionaire taxes. Experts predict that in the next 5 years, the concept of personal taxable income for billionaires might become meaningless. If most of their wealth is tied to digital assets held offshore, and all their spending comes from loans they never repay in life, the IRS may never see a dime. Future risks in public backlash. The more this loophole spreads, the greater the risk it triggers political and economic consequences. Governments lose billions in potential revenue, money that could fund infrastructure, schools, or healthcare. That shortfall? It often falls back on middle-class taxpayers. Already, whispers in political circles suggest a looming global crackdown. A leaked EU memo calls this the most urgent corporate tax threat since the Swiss bank crisis. On social media, young activists are calling for digital wealth taxes targeting exactly these multi-country trust structures. If history repeats itself, we could see high-profile billionaire trials, frozen assets, and international sanctions. But until then, the super-rich are cashing in without fear. Here's the truth. Every time a new loophole is closed, another one is quietly opening somewhere else. Tax laws are like Swiss cheese, full of holes. And the people with the best maps are always those who can afford the guides. So, the real question isn't how do we stop this, but rather, how long before the rest of us even find out it's happening? We're witnessing a cat-and-mouse game where the rules are constantly rewritten and the cat is always 5 steps ahead. And here's the irony. Some of the same billionaires exploiting this loophole are publicly funding charities, green initiatives, and education programs. It's the perfect PR shield, but it doesn't change the fact that their tax bills remain at zero. One thing is certain, the conversation around wealth, fairness, and taxes in 2025 is only just beginning, and the stakes have never been higher. If you found this breakdown eye-opening, hit that subscribe button. We've got more deep dives into the hidden systems shaping your money, your rights, and your future. Trust me, you won't want to miss what's coming next.